podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to the Hedged Edge by RCM Ag Services, where we're getting out of the field and onto the mic to bring you weekly market updates, commentary from commodity experts, and monthly interviews with the biggest names in agribusiness. Welcome to the Hedged Edge by RCM Ag Services. I'm your host, Jeff Eisenberg. In dreaming out the idea to start an agriculture podcast, I listened to dozens of other podcast pioneers before me talk about everything from USDA reports to agronomy to technical innovations shaping the agriculture landscape. The Hedged Edge promises to include many of these topics, but to do so from a perspective of managing risk related to your business's bottom line, and the bottom line to all involved. Our goal is to provide value to the world commodity markets while turning a profit. For our first guest, we're cutting straight to the top, as in cotton and options trading. And we're not talking to any old expert. We're talking to the king of cotton, emperor of options. Not sure, Ron, you're really going to like this. Ron Lawson. Ron has over 4 decades of agriculture risk management experience, and we're happy to have him here with us today. Welcome, Ron.
Well, yeah, you make me feel a little old with that introduction. I don't feel old, but I may look old. Started in agriculture, grew up in agriculture, went to school at UC Davis. I wrote my own major, livestock production management. They didn't have anything like that at the time, so I penned it and put it together, and I got my bachelor's there. Proceeded to go work for McCormick Schilling Spice Company, of course. It's nothing to do with cattle at all, but I was a field manager, and I ran their raw materials in the field. We had about 90,000 acres of onions, 40,000 acres of garlic, and then moved into the plant to run the raw materials, got poached away by Christopher Ranch to help run their garlic operation. Way back when, was helped start the Garlic Festival, moved on to work for Merrill Lynch. And that's an interesting transition, and most people won't realize this and may not even care. But you can only grow garlic in the same soil once every 4 years. There's a nematode, a root stem nematode that infects the soil, if you will. So you've got to rotate the crops. So we would grow corn, wheat, onions, and then garlic. And in the off years, the corn, the wheat, whatever we were growing would need to be hedged. And that's when I learned to cut my teeth on hedging using futures in the market. Well, when I left the dirt and went to wear a suit and work for Merrill Lynch in the San Jose office, this was at a time when high tech was booming. We literally had guys walk in the door, and the broker of the day would get that person, sit down, and say, "Yeah, I got a company I need to take public." And the likes of Steve Jobs and these other guys would walk in. And the little San Jose office of Merrill Lynch had more IPO origination than any office outside of New York or London. Wow. It was a wild time. It was a great time. I was brought on to take over a futures trading desk. I opened a few very visible, well-known names in the cotton world, one of which everybody wears their jeans. And they said, "Well, geez, if you can do that out of San Jose, we're going to move you to Los Angeles, where our cotton desk is." The older fellow, the German fellow named Klaus Sunder. And Klaus was the cotton king. And
you took over his name now. That's good. I like that.
Yeah, so
now you're the king.
I hooked in with Klaus. He retired. I ended up as heading up the cotton desk, the regional sales manager for Merrill in the Western States. We managed everything. I oversaw everything from the Mississippi to the Pacific. And then Merrill made a transition, and it's similar to what we're seeing a lot of today. They got out of the brokered futures business and went into over-the-counter, OTC only swaps through their capital markets division. And so I moved on. Went to head up Prudential desk, their cotton desk. They got bought by Wachovia. Wachovia didn't want to have a futures operation. So I started my own company, Steadfast Futures and Options. Along the way, with my partner, Bill O'Neill, who was the head of Merrill Lynch Futures Research, we started Logic Advisors. It's a Lawson O'Neill Global Institutional Commodity Advisors. So we write research on a daily basis. It goes out around the world to the biggest cotton players, metals. Bill handles the financials, the interest rates, currencies, metals. I handle the agricultural products. So my cotton letter is kind of one of those must reads anymore. Goes out in the morning through the RCMA group to growers, and then in the afternoons to a little bit of a higher level on the pecking order to hedge funds, commodity banks, merchants. And it's just, one of those things. After a while, you do it so long, after 38 years, it just kind of becomes, right into stride. You just produce it, talk about it, get it out to people, and hopefully they read it.
Daily routine. Yeah, right. And you're doing that all out of the office there in Sonoma, but your partners, you've got partners. You've got Bill O'Neill, who writes the economic piece, and I've been following now for quite a while. He's been spot on. I mean, he's nailed these markets. He's
he's the
king of the global macro. Let's be honest.
Yeah. He's the wily old cat who's been doing this for so long.
Yeah.
And back, we can say this now, it seems like forever. Back in the day when you could actually go into Manhattan, he lives in New Jersey, and be on TV, because he was the guy that, they would bring on to Bloomberg, CNBC. And he has this broad scope of commodity understanding. So whether you want to talk about copper or the 10-year note, looking at currencies, he's got a good oversight of that, and I'll tell you, that's part of our presence in the industry. Gone are the days when you can be a specialist in a commodity, only that commodity and nothing but that commodity. There's too many other cross currents that have to be followed. Having Bill's side-by-side research keeps us on top of the things that people may not necessarily be looking at for a particular commodity. Right. And cash flow right now is one of those things, and we're all over that for people to talk about. When the Fed is telling everybody they want inflation, we're pumping money into liquidity into the global economic space. You just go back to your college economics 101, macroeconomics, right? When you have excess funds chasing the same number of goods, that's inflationary. Then that's what we have going on right now. There's so much money searching for alpha, trying to find a return, that they've discovered commodities. And now commodities are in favor, because how much more leverage, how much more money do you want to put into a stock market given the current macro environment? So having Bill on board, on a daily basis keeps our head pointed straight. We also, Peter Egley, who's one of the renowned cotton leaders in the world. He's one of the guys that everybody talks about at the conventions and listens to. He's on board. Plex, yeah, he's on the board of Plexus, and he's one of the top risk managers in the world. So we've got a good generalist. We've got a highest specialist out there, and then I'm kind of the guy in the middle that are trying to put the pieces together on the future side as well as on the research side. And
I think what you guys are doing is spot on, and you're really, the team you put together is phenomenal. And the reality is, as you've mentioned, you've got the generalists and yourself also completely engaged in not just cotton, but understanding of what's going on across the global landscape of all the commodities, because each one of them has a push and pull tied to each other. Should we plant more cotton? Should we, based upon the price of corn and soybeans and what's going on in China? And, of all the people I've talked to in recent times, I feel like, you've also got a pulse of the export market and a sense of what's going on there and what really is happening on the ground in China. I think it's kind of interesting if you could maybe share some, your perspective on, what is going on that side of the world.
One thing I try and get across to people is cotton as a commodity is one of the best and longest leading economic indicators there is, and it's simply because it takes a greater length of time to go from conception to consumption, if you will, right? And along that array, you've got to pay for insurance and interest rates and energy and transportation and the insurance. You weave it, you cut it, you dye it, you sew it, you ship it. So it's subject to so many different cross sections of the global.
Sounds like the 9 months my wife was pregnant. A lot of cutting and sewing and spending of money and lots of stuff going on. Yeah,
that's right. It becomes so sensitive to everything that it's a good barometer of what is happening out there. I always say if we're heading for Armageddon, cotton would already be there.
Yeah.
So we're not. And so what is going on in China specifically? There's a couple of different moving parts specific to cotton. In eastern China, Xinjiang province, where the bulk of their production is there's a current. I'm going to just use the term like kerfuffle. The Chinese claim that everything's perfectly okay. The rest
Can
of
you
the world,
eat a kerfuffle?
If you fry it.
Okay, all right.
So the Chinese claim that everything's perfectly okay. The rest of the world is saying no. You've got labor camps, you've got child labor, the human rights. It's horrible. So underway today, as we're speaking, the global clothing environment is: we will take no cotton from Xinjiang, and we will take no yarn, fabric, gray goods that have any Xinjiang cotton in it. So that puts the Chinese in a very peculiar situation in that their biggest producing area can't be used for exportable goods.
Right.
But they're a net importer regardless, so they can convert and use Xinjiang cotton domestically. Okay, that's the specific cotton side. They're building back up their strategic reserve cotton. The Chinese have strategic reserve for corn, for soybeans, for wheat, for energy, for cotton.
Right.
So they're starting to rebuild that now. So there's a demand in the market. As we sit here today, cotton is trading for 99 cents in China, and we're like at 72.
Right.
Okay, so they've got tariffs against bringing stuff in. Now there is no tariffs on the yarn, so yarn importation to China is rampant. And so you get markets like Bangladesh, India, Pakistan. They're all buying U.S. cotton, converting it, selling it into China. Now, while all this cotton stuff is going on, and we see it, we see the flows, we see what's going on, what you have is a macro shortage of calories. So if you go back 15, 20 years, the average person in China ate animal protein once or twice a month.
Right. I think this is the most important thing that's going on over there that people don't understand. Yeah.
Today, they eat protein 4 or 5 times a week.
Right.
Now, that seems like a big chunk, and it is. But here's the real fulcrum. It takes between 10 and 12 units of vegetable protein to be converted into animal protein. So when you go from twice a month to 4 times a week, it's an exponential increase in the demand requirements for vegetable protein to be converted to poultry, to swine, to cows. And so that leverage, because they've gone into such a massive demand, has caused them to import grains. Now, sure, the phase 1 deal, they've got to buy from us if they're going to stay in line, but they need it more than that. Last year, they suffered through the African swine fever that killed half of their crop.
Yeah.
Of pigs.
Half their pigs. Yeah.
Half. And when you consider that amount, to replace that amount, every other hog producing country in the world would have to ship their entire inventory to China.
Well, now you've got Germany, ASF showing up in Germany, other parts of Europe. So we've got struggles all over the globe now related to ASF, and they're still in need of the hogs, and which means they're in need of the protein that goes into to raising them.
Right. We saw the DG demand. So the what's left over after you make ethanol, the DGs, they were buying those forever. They're just sucking everything over there. Then they killed off half their herd, and now they're rebuilding. And so they're starting, that demand is coming back. At the same time, though, that their crop, they had 7 typhoons come up the Yangtze River Valley this year, right, and wiped out a large swath of their crop. So China is really in a pickle. They need our calories. And so then when we look forward and say, okay, well, what does that mean for the future? We can argue about whether cotton prices or corn or wheat are going to go up or down, or soybeans right now, but we know there's a rising demand in the future, and it's a given. they're going to have more people next year than they will this year. The demand for food is going up, both for human and animal consumption. And there's questions over what they're going to grow. So some people feel that they're going to change over their production in Xinjiang from cotton over to wheat because they can grow it in the desert environment. Okay, that's fine, but that just means more demand for U.S. cotton. So if you're going to grow more U.S. cotton, it's going to have to be price competitive. Well, when you look at the price of soybeans for next season compared to the price of cotton for next season, cotton's got to go up above 85, 90 cents to compete just to get acres under the ground.
Right.
So that's where we're looking at from this standpoint, and trying to make sure people understand the macro side, as well as the fact that, yeah, we were up double digits today, and the market looks like it's going to, continue to rally.
I pulled up a piece from your newsletter today that I want to read to everybody here, because I think it's actually really, really important. And maybe Allie will be able to figure out a way, marketing be able to figure out a way to get this online for us. But you said, regardless of where global demand may originate, the fact that American farmer can produce more from less, especially with a weaker dollar, will give the U.S. a huge advantage in the world's agricultural marketplace into the future. Can you expand on that a little bit? And I think it really ties in with what you just said.
Yeah, I was referring to a chart that I found. It was actually put in on a LinkedIn post from the guy that runs Harris Ranch Feedlot out here in Coalinga.
Yeah.
It's one of the biggest West Coast feedlots. And the chart shows, going back to 1948, the trend of input costs versus yield. And what it shows is that the input cost is less today than it was in 1948, but the U.S. farmer produces 3 times as much food on the same inputs.
Yeah.
And my point to that was, competitively, we still have the advantage globally. So regardless of what crop you have, good, bad, or ugly, up, down, or sideways, the macro underlying demand, we're going to be more competitive to sell our goods overseas. Now, with the U.S. dollar coming down in strength, we're going to have even higher demand, because in foreign currency terms, our goods are less expensive.
Right.
So just as we're more efficient, we're able to produce more for less of a cost, we have a greater demand. So to me, that paints a pretty bullish profile out there.
I think that makes perfect sense. And the weakening dollar is on everyone's concern list, inflation. And I think it really segues into the next topic I wanted to bring up is, all right, so we're armed with all this information. Bill's writing the economic piece. If you're deeply involved, you've got yourself focusing on cotton. But let's just think about this related to risk management and how it relates to the bottom line of both a commercial operation all the way down to a local farmer. Is what can people be doing to mitigate the potential risks associated with inflation? I mean, earlier today, I was on a call, earlier this week, on a call with a company that they use lumber as a part of their large projects. And guess what? If you look at a lumber chart,
They got killed.
It's through the roof. They're trying to price their lumber as a part of the job, and they're off base. The spread is way more than they had budgeted for, because, well, they didn't risk manage or put a hedge in place, and not a lot of people did. But let's just apply this back. What are your thoughts on how a commercial operation or a individual can really step into these markets and manage this inflationary risk that is staring us all down?
I think, the traditional answer would be, you've got to hedge. You've got to hedge.
Right.
But I think conditions today are so much different that hedging, we used to say, buy the bale, sell the board. That kind of hedging doesn't work anymore, simply because the outside market forces now are driving the bus. If you will, we say the specs got more money than the trade got cotton.
Yeah.
So
hey, is that a Lawson's law?
No, that's one of Lawson's laws. Yes.
Okay, I know we've got a couple of them. So, all right, that's the first one at least.
Well, that's what, yeah. And in a time when the markets are indifferent, when the speculators are indifferent and don't really have a long or short side opinion, then the fundamentals alone can drive the market. Supply, demand. It becomes really a simple formulaic move. But when you input into that, and this is where we try to help out our clients, the outside pressures, then it changes the dynamic significantly. So instead of hedging your buy the bales, sell the board, hedging with futures, we are begging people and instructing and have finally got people to understand to use options instead of futures. Now, firmly believe this. I can prove it on paper. I can prove it in actual performance. You can do anything with options that you can do with futures. But there's things you can do with futures that you cannot do with options.
Right.
So the ironic situation is when a person first starts to learn about risk management, they learn how to trade futures before they learn how to trade options, because an option on a futures contract, right?
Right.
But in reality, you ought to start with options.
Right.
And you have an opportunity to be wrong without getting killed. Right. In the market.
Right.
So it gives you some flexibility. It allows you to take protection without commitment. And a lot of times that's more than anybody else is looking for in the first place. They just want some protection. It's like insurance. If you didn't have car insurance, would you have to buy a second car in case you wrecked one, right?
Right.
But you have insurance. Well, that's what options are to futures. Right? You don't have to lock in on a futures contract, long or short. You have an option. So now it's your choice, not your obligation.
I think those are really points well taken. So as you think about where the futures and options markets have evolved to, it's not just a basic strategy; it's a necessary strategy. And yourself, ourselves, myself, I'm out talking to banks and producers on a regular basis, trying to help them all understand the importance that you have to budget for this in your operation. And there's a couple different ways to do it. You can utilize the futures and options by opening up futures and options accounts, but you can also accomplish a lot of this sometimes through cash contracts or over-the-counter swaps. And there's so many different tools available to, again, both the merchants and the commercials as well as producers today, that I think that people really need to have all these tools available in their toolbox.
Right, and I we can on another broadcast go through the ways that we teach guys how to understand options. There's a few stories we can tell that really bring it home, and I just encourage people to read about it, talk about it, and probably the most important step in understanding options is to teach it. And it's when you teach that you learn the most. Right. And so what I always say is, if you're going to get out and talk about puts and calls, and I say this with all respect, get out the crayons, get colored markers, okay? And then whenever you're talking, and write down what you're reading for your understanding. And whenever you're talking about a long call, owning a call, use one color. When you're going to be short the call, use another color. Long the put, short the put. The colors tend to force your brain into having a better understanding. And so when you start being able to talk the language that comes along with the game, your mind already has the understanding because you've used these colors. It is an absolute proven fact that works well. So what you do is you do it on paper. Get out the crayons, and as soon as you believe that you've got it halfway understood, go teach your kid.
Right.
Teach your wife, teach your girlfriend, teach your boyfriend, teach your dog. I don't care. When you explain it to them, all of a sudden it clicks in your head. It's magic. And I don't know why. I'm not a psychologist. I'm not a brain doctor. I just know that when you teach things, think about it in your life, when you try and explain things to people, you understand them better. So that's one of the first steps I suggest people take when they start looking at options. The only thing I can guarantee in an options market is that time decay will eventually take away part of the value of the option premium. It's a guarantee. It's an absolute. So what I explain is you want to, if you're going to buy an option, it gives you the flexibility, the choice, but you have to pay for that choice over a period of time. If you're right on the direction of the market and the time decay takes away from that value, my suggestion is sell another option that time decay adds to your position.
Right.
So you're losing time decay value on one hand, it's helping you on the other. So now you've eliminated that from the whole program. Now you're looking at just volatility and you're looking at price direction.
Yeah, and a lot of risk managers out there and customers that I've talked to, and I'm sure people you've dealt with, they've received advice that they need to set a floor as markets are rallying, like we're seeing right now with commodities inflating, whether it's corn, beans almost at $11, cotton over 70 cents. If you're growing the crop, you need to set the floor because your insurance, you have a big gap to where your insurance actually kicks in.
Right.
So a lot of people suggest to buy an option. Well, if you just buy this option, you run the risk that you're just spending money and you don't necessarily have, you could easily finance a portion of that purchase through the selling of options. Now, it can be complex for a lot of people, but the same thing, it becomes very important for people to understand. Now, can you just real quick before we leave this topic, you flip it to somebody who's actually consuming cotton right now? They are trying to be competitive in the world, whether it's a Levi Strauss or a Abercrombie and Fitch. They need to buy cotton, or if they were General Mills buying corn. Prices were very deflated post-COVID or during COVID. Many people at that time should have been forward thinking and buying protection of inflation. Can you talk from the commercial side just real fast?
Sure. On the commercial side, you have a little bit on the long side of a little bit of an advantage in that you can buy calls which protect against the market going up. You can set a ceiling, the most you're going to have to pay, and now you got a budgetary backstop to push against. So to sell an option against that, there's two different ways to look at it. You can sell a put below the market, take in the time value that will start to decay. And then if the market goes down and you end up buying the product at a lower price, well, you budgeted here, but because the market went down, now you're buying it here. Okay, that's a windfall. Now, on the other hand, you can buy a call to protect against the market going up, or you could sell a higher price call. So that what you're selling up here helps pay for your protection. In the worst case scenario is the market goes up through your price, you're protected, and then this is all profit on the upside. Now, in reality, I will say 90% of the time, it's not always, a rising market will show a shrinking basis. So while the futures markets are going up, that cash position that you're protecting isn't following as fast.
Right.
So selling the calls above the market, where normally that's not such a good idea because there is no top to up, right?
Right.
So, but as the market goes higher, you're able to have a stronger cash basis, a weaker cash basis against the stronger futures. So you'll make more on the call spread than your prices will increase on the cash market. So those are the kind of strategies we tailor to the specific need of the market participant, whether they're net long, net short. Then here's just a simple thing that I try to say to people. Sometimes they get caught up in, oh my God, how am I going to hedge this? I'm obligated to buy that, but I've sold this on my order book. And it's really simple. It's really simple. How much, how long, which way?
Right.
That's it. Those three questions. What is your net exposure? How much?
Right.
Over what period of time? And this is the most difficult one for most people. What direction does the market move hurt you? because often we deal with the merchant community, they're buying and selling. And sometimes the left hand doesn't know what the right hand's doing.
Right.
Often in a very fully integrated, say for instance, you were a big denim manufacturer, your purchase orders and your selling orders, you may not have two guys that are looking at the same thing. So you need to know what your net risk is, how much, how long, which way. If you can tell me that, I can build you a hedge, a risk management scheme that'll benefit you in the long run.
But I'm hopeful, Ron, and again, putting this podcast together and thinking about the importance of people's bottom lines and their margins and their businesses, is that any sort of preconceived notion that people had in the past that risk management was just kind of for the birds or for the old school gets actually reinvented back to the new generation of people that are involved in these commodity markets. People coming out of school today are taught to evaluate budgets and margins, and this notion of utilizing financial markets to hedge or risk manage may or may not have been something that they learned, and most of the cases not. So it becomes us, I might not have as many gray hairs, but I've been doing this long enough to know that financial markets provide a vehicle and a mechanism for people to mitigate and manage risk across all commodities. And I would hope that the people you're talking to, your newsletters, the reach that you have can get in more people's hands so that becomes more prevalent across all industries.
That's what we're hoping. A lot of what we do is educate, and I can tell you we're at a cusp right now in the crossover between technology and commodities. Similar in a way, when I was in college, back when I was at university, it was a transformation in agriculture where your value as a farmer, what you were measured up against in your community, what was your yield?
Yeah,
that's all that counted. What was your yield?
Right.
And he's an 80 bushel guy. He's only a 70 bushel guy, right? That was your measure of.
He didn't put enough water on. Did you see he didn't run his sprinkler? Yeah.
Right. So I remember being in class in an agricultural economics course, and a very smart guy, professor, and he goes, "I want you all to forget about the best farmer you know. Forget about it. Here's what counts. How much money did he bring home at the end of the year?"
Yes, sir.
So at that, it was a revelation to me, because I grew up in farming and knew that this guy was this guy's dairy herd. This is he had 80-pound difference. This guy was so many bushels. This guy and now all of a sudden it's, well, yeah, he may be have the highest yield, but the lowest net return because he just poured on and wasted a bunch of fertilizer. Okay. Right. So we're at that same flash ahead 40 years, 50 years. And now we're at a situation where it's not your net return, it's your risk management that guarantees you a return at the highest, what I call sleepability factor, right?
Right.
It's not quite this simple, but there's formulas. If you follow, you will grow a good crop. If you do what's right, you can go online, find out what to do, how to do it. But what you do with that product, that's where the effort needs to go in these days. And because there's so many different choices and different options for guys to utilize, that's now they got to reach out instead of to the extension advisor at the UC farm system. Right. Now they got to reach out and say, tell me, how do I manage the risk on this crop going forward?
Right.
So, similar type of shift, little quantum shift there. And I'm just proud to be able to say I've been through these shifts and still standing. So what can we do to help people?
Well, you could serve them some wine, I guess.
Yeah, someone's got to live here. We got houses and stuff around, Like I told you earlier, the rumor has it there's wine deserves drinking in these parts.
Well, once COVID's kind of settles down, it's your first stop on the list for me. I got to get out there and show me around. I can't believe you're telling me about the ashes flying. So you're on the Rotary. Yeah. You're on the Rotary Club. You're the president of the Rotary Club, and read that you guys are kind of leading the effort in Sonoma right now to kind of fight the fires or fight explain to me what's going on.
Well, it started back in 2017 when we had the fires here. They got pretty close, a couple blocks from our house. And what we did at the time was we took our farm out here. We had a large facility that we were able to accept donations.
Oh.
And in 4 months, we took in over $1 million in donations and goods and distributed them to the people that were hurt. And it was, giving the first responders that were working in gift cards to the local stores to try and increase the velocity of money within the community so they could hire people, keep them working. And we did a pretty good job. And then it was a model that was taken on by a number of other communities. So this last go around that they've had, it's been a terrible thing. All these fires are very unfortunate. We won't get into the political side of it up or down, but the net difference this time is in 2017, they lost 9,000 homes in one town, Santa Rosa.
Wow.
This year, they've had the biggest per square mile fires.
Very few homes are lost, right?
900 structures all told. Now,
right.
Yeah, some big wineries, some very fancy hotels. It's terrible. There's no way around it. But when you look at the amount of human problems created, in reality, it pales compared to what happened in 2017. So we're helping where we can. Hopefully the fires, we're not out of, we're in red, right as we speak, we're in a red fire alert because of the winds coming in, and we'll need a good soaking to solve this, and we'll keep our fingers crossed. So.
Yeah, we're hoping for you guys out there. It's wild times. I did hear today, Colorado's fires hope to get a little bit of a damper because of some snow that's coming through and other things, but yeah, wow, wild times. Well, you keep up the good work out there. I guess to wrapping things up, I got a couple rapid fire questions here for you if you're up for it. So are you ready?
Yeah, bring it.
All right. So since you are in Sonoma, white or red wine?
I prefer Sonoma Reds, Napa Whites.
Okay. Is there a certain you're talking Pinots or Cabs, or what do you go for?
Yeah, the Pinots in the southern end of the valley. You get all the bay breezes, the San Francisco Bay, so they're a little light, little. They're nice. Get the heavy iron red soils up valley, and they're a little more body to them. Over in Napa, we always say here in Sonoma we have great wine. In Napa, they make good auto parts. But yeah, they do a nice job on the whites over there. They'll claim their reds are better, but that's just my personal preference.
All right, that's good. Yeah, I'm a Pinot guy. I'm definitely a big fan. But if I was sitting there with you, I'd drink whatever you're serving. Favorite garlic-based food? I read one time there is garlic ice cream.
The Garlic Festival was a wonderful thing. It was created to raise money for local nonprofits.
Okay.
And that's all it does. And the way they do it is you have a booth, or you have your food, you pay for the booth to the school, to the Garlic Festival. You pay percent of sales, and they take the money, and that's the seed money for the following year. Okay. And what they do is all the volunteers put in their hours. So the Boy Scouts, the Girl Scouts, you name it. And then they divide up the number of hours over the profit, and they give you that. So it's all for earning money, with the exception of beer sales.
Okay.
So now it's alcohol sales as well. They sell in a 3-day event more than $1 million in alcohol.
Wow.
So the garlic there, they came up with, they've got garlic everything. My favorite is Gilroy garlic steak sandwich and tri-tip, bell peppers and onions cooked down. They take the bread, they toast it on the fire, and then they dip it into the butter and garlic that's been warming on the fire. They put on the meat, they put on the veggies, and wow. If you do it right, it runs down your arm just nice. So that's the garlic steak sandwich.
That sounds pretty good. I have a couple issues with garlic. One is that I love it so much that my wife doesn't let me sleep in bed with her after I've eaten enough of it.
Both parties have got to enjoy it. That's just part of the game.
I don't know what it is, but she says that it kind of secretes through my pores, and so I don't know. But
no, she's right. If you take a clove of garlic and rub it on the soles of your feet, you'll smell it on your breath. And the reason is, this is the scientific side. It attaches to the red blood cells that are oxygenated in your lungs.
Okay.
And the active attractant is called diallyl thiosulfonate, and it's actually in the old days was used as a low-grade sulfa drug.
Okay.
But that's garlic.
Well, I mean, I can't go wrong with garlic bread, so I'll put that at the top of my list to start. All right, last one is what is your favorite extreme sport that you either participate in or wish you could, whether it's in this life or another one?
This is a simple one. From the time I was 17 till the time I was 32,
Okay.
I played the game that they play in heaven, rugby.
Ah.
I was fortunate to play at a very high level, represent the United States. If I could still play, I would still play. And as they say, soccer is a gentleman's game played by ruffians, and rugby is a ruffian's game played by gentlemen. And I consider myself a gentleman. Fond memories traveling around the world playing. I got many associates in foreign countries that I know through rugby. And I will tell you, in Australia, where it's a sport, it's a religion.
Australian rules, yeah.
Aussie. So that's helped me in my business. They grow a lot of cotton down in Australia, and so the rugby is my athletic drug of choice.
That's good. Well, I've guessed too. I was not prepared for your rugby comment. I play lacrosse myself and still play today. I'd love to get out on the rugby pitch with you if you willing to give a couple throws with me, but we'll have to do that one.
The closest I can come to a rugby performance anymore is in the after party. I'm really good at that.
Well, you bring the wine and somebody else will bring the football.
All right, sounds like a plan.
All right,
I look forward to doing some more of these. We'll do an options 101 to get people to take them from square one to actual training. We'll do that down the road, and look forward to doing some more of these in the future.
I think that's what we do. I think it makes a lot of sense. Have to get out the crayons and the markers and maybe a whiteboard or two and see if we can put some stuff together that way. And get some feedback. Maybe we'll do a live event where we can get some people asking questions. That might work. This has been fun, Ron. I appreciate taking the time and being the first participant in the Hedged Edge. And, we're going to get together here sooner than later, hopefully once this COVID deal's over. But
yeah, sounds great.
All right, Ron. Thank you very much.
See ya.
You've been listening to The Hedged Edge. Links from this episode will be in the episode description of this channel. Follow us on Twitter at ag_RCM, like our Facebook page under RCM Ag Services, and visit our website, read our blog, and subscribe to our newsletter at rcmagservices.com. If you like our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear them.